Okay, folks, welcome to Thursday Night Stock Charts Live. This is where we review the closing price action of the major averages. But before we get into it, I hope everybody had an awesome Christmas. I know Hanukkah is still going on, and we're getting ready for the new year. So counting counting down those moments to a new year, God willing. Okay, before we get into it, we're going to do chart requests. And if you're not currently in our forum where we post the chart requests here, use the link in the chat box, get signed up, enter your symbols. It's probably going to be a quiet night, so I should get it to everybody tonight. And there's the link. Just head on over, sign up, no credit card required. Head on over, enter your symbols here, like everybody else did. And we have Sean, Gay, Tim a couple times. You got it, Tim. All right, and if you want our premium chat room, it's right here. Bull Bear Banter, great people, great stuff going on in there, and great community. So please sign up. It's very, very inexpensive, just enough to keep the lights on here. So please head on over, help support the channel. And the show is going to be brought to you by, of course, our favorite sponsor, TrendSpider Automated Technical Analysis. If you're not using TrendSpider, folks, if you're not using TrendSpider, folks, you're missing an arrow in your quiver. Were you an archer? Automated technical analysis, backtesting, fundamental analysis. It's the Bloomberg for the retail investor, but at a fraction of the cost. There's a link below. Get a bare minimum 35% discount code if you're watching this on YouTube. Link above on Twitter. I give it away free to our silver and gold level members. That's how much I believe in it. Predictive backtesting through AI. Build your own indicators. I use it every single week when we do the week ahead commentary and best stock charts for the new trading week. This is where I get my trade ideas from. Automated trade alerts and automated execution of your orders when you sign up with your broker. I think that you use Interactive Broker and a few other brokers. You could just use their bots and trade off of, they have Ally, all these guys down here. So it's called Signal Stack. They're partners, if not under the same umbrella as TrendSpider, Signal Stack, and they will fire off your orders. So again, 35% discount code. Use that link below. Help support the channel. I would appreciate it. Let's say hello to folks. Tim, thank you very much. Appreciate that. George, welcome. Hope you had a great Christmas, everyone. Okay, let's get to it. Let's talk about the economic data. First, this is an important topic to bring up before we get into my commentary, because this is a typical week in terms of historical trade. This week over last week, this week over last year, it's the same. Pre-Christmas, post-Christmas holiday trade, very thin volume. It is not indicative of how the market should be trading during a normal business week. So I even questioned whether or not I should be even doing the show tonight, because what you're seeing is not reality. What you're seeing are retail traders trade against other computers, and computers trade against other computers, because there's no whales around. They're all skiing in Stad. They're in the Caribbean on the private islands. They're not focusing on the market. They're having a good time. Now, after the first of the year, different story. They will be back in earnest. So let's talk a little bit about economic data that came out this week. And this is reflective of last month, so it's worthy of the conversation. Well, so consumer confidence for December, it's a December read, but still relevant. A big miss, a really, really big miss. Durable goods, they expected a positive number for November. We got a negative number. Durable goods ex transportation. I don't know what they were expecting, but they got a negative read nonetheless. New home sales missed by a long shot. Obviously, yesterday was Christmas. Today, initial jobless claims, they came in less hot than what was expected. Tomorrow, not much. Advanced U.S. trade balance. Nobody really cares anymore about our balance of trade. They used to. Back in 1987, when the stock market crashed, they were worried about the trade deficits, budget deficits. Now nobody cares about it. So next week, when we roll back in town and we have, it's not even going to be a full trading week next week. It's going to be more of the same. But just taking a look anyway at the economic data. Hey, Sean, we have Chicago PMI. It's coming out on Monday. Case-Shiller home sales, not a big deal. Thursday, initial jobs claims. We get that each week. Construction spend. And on Friday, ISM manufacturing. So not a big week in terms of economic data coming into next week. So it's just going to be algorithmic trade. I can't speak today. Algorithmic trade driving the market. So I've been stressing that I am not putting on big positions one direction or the next right now, because we have no idea which way they're going to take this market up at the beginning of the year, because new money that's been sitting on the sidelines, tax loss selling, which occurred last month, that money is sitting out there to get put back to work. So I can argue till I'm blue in the face the reasons why the stock market should go down. Doesn't mean it's going to go down. Not right away anyway. So let's talk about the valuation of the market. And the valuation of the market is at its second highest on record relative to the dot-com bust. So, earnings better be really, really good. Really, really good. And the problem for the overall market is that you have only 53% of companies are trading above, on the S&P 500, trading above that 200-day moving average. So breadth is not good, or has not been good. It may be okay this week because the computers are in charge, but we have a very expensive market. It's not just on a PE multiple basis. It's on a price to sales, price to book, forward-looking multiple. This is the rear view mirror multiple. It's very expensive. It's very expensive. So, I just started an ebook of The Intelligent Investor from Benjamin Graham. And that is what Warren Buffett cut his teeth on, learned his lessons from Benjamin Graham. And this is hardly a market right now where you'd have an investor like Benjamin Graham or Warren Buffett putting new capital to work here. They're raising capital. So I should say Warren Buffett is raising capital, has raised capital, and he's waiting to put it to work. And as the Intelligent Investor says, all bull markets usually end ugly, and this is not going to be any different. So what do we have coming up that could act as a catalyst? Well, we have the incoming Trump administration, and people may be out there saying it's going to be great for the economy. I think that whatever value that people have seen from a Trump, or expect from a Trump election, has already been priced in. And the analogy that I use is that to fix this economy, it's akin to being, unfortunately, on chemotherapy, and sometimes the cure is worse than the disease. So you also have the problem with the deep state coming in, or the Trump administration coming in, and the deep state throwing logs down the hill, trying to get him from executing on his policy. And what will that do? What will they trigger in this economy? So I hate to be a doom and gloomer, but I don't want to be a cheerleader either. We have plenty of those on CNBC, Fox Business News. I would rather be a pragmatist and use history to divine where we may be going. And in terms of valuations, this market is priced for perfection, and market breadth is not good. Too few stocks are driving the market up higher. That's a problem. And when we take a look at the Buffett indicator, and this is another method of valuation, and it's the size of the stock market relative to the US economy. And we're beyond 2 standard deviation move beyond the historical trend line down here. So no matter how you slice it, again, PE multiple, rear view mirror, forward looking, price to sales, price to book, Buffett indicator, we're overvalued, very overvalued. It's not just we're slightly overvalued and we can hope to grow into the valuation. No, we're very overvalued. Looking at, let's say hello to folks. Talon, welcome. Mr. Sean, we said hello to. And Donnie. Hey, Donnie. I'm looking at my jawline here. I put on so much weight these past couple of days. Okay. Let's take a look at the probability of a rate cut in January. This is actually increased from an 8 handle to a 12 handle, but the probability is still very low that we're going to get a cut in January. But taking a look at a March read, that's pretty much unchanged. May, about the same. The odds of a cut in May have come down a little bit. I don't want to go out any further than that because that's pure speculation. Frankly, May is pure speculation at this point. Looking at initial jobless claims, which came out today, and it's just an illustration because we don't want to always be doom and gloom. I spoke about this chart on Sunday Night Futures Live, and I warned that this level here, 260,000 jobs, we break out and above that mark, that's going to be a problem. I'll guarantee you one thing. This Fed Watch tool is going to be screaming rate cut. So watch out for that 260,000 mark. We're consolidating. We're putting in lower highs, and I've drew a trend line here. We could just say, you know what, this is a wedge formation, and we're at the apex of that wedge formation. So either we're going to break out or we're going to break down very, very soon. My guess is we break out. And that was initial jobless claims. Now, unemployment in California, this is what, the 5th largest economy in the world, maybe 6th now. Unemployment in California is skyrocketing. The number of unemployed persons in California reached a whopping over 1 million, the highest in 3 years. Unemployment has jumped by 322,000 jobs over the past 2 years. At the same time, unemployment rates spiked to 5.3%. I don't know if you can call this recessionary. They're horribly run there in California. I don't know if it speaks to the overall nation. I won't go there, but it's certainly not a good trend because in the past, it has predicted when these lines in gray mark recession. And each time we get a drive up higher, it's meant recession. So is it different this time? I'm very reluctant to say that. Usually people who say that have egg on their face. Taking a look at the Fed's balance sheet, the Fed's balance sheet has pretty much flatlined. And I think that this is the longest period of consolidation since the Federal Reserve began rolling debt off their balance sheet back here. We did have this spike up. This was the regional bank crisis, but that faded away and they resumed their bond selling. But that appears to have faded a bit. So I've been of the mind that prior to the Federal Reserve cutting rates more aggressively, they're going to tweak their balance sheet more. They're probably going to be buyers of last resort. Why? The reason is that when you take a look at bond yields, since the Federal Reserve began cutting rates back here, have only gone up. Not only have they gone up, they've broken out. And we're sitting precariously at levels where we do not want to be. You have a lot of zombie companies out there. You have the mid caps, which have come a long way. Small caps have come a long way. They need the banks. They need cheaper interest rates. And if this continues, this is going to be a problem for the equity markets going into 2025. So what can the Federal Reserve do about this? What they can do is they can go back to the market and say, okay, we're done with rolling off debt off of our balance sheet. Because what is this debt? Mortgage-backed securities, long-term debt, 20-year, 30-year paper. They'll begin buying this debt back and reinflating their balance sheet. They usually put a name on it. The last one was not QE, but it was really QE. They just didn't want to call it quantitative easing. They'll call it something different this time. But it's an admission that there's not enough demand for our inflated debt loads, and they need to step in and they need to be buyers of last resort. So the Federal Reserve, at some point in time, I'm predicting in 2025, will be back. They will be buying our debt, driving longer-term yields down. Cutting short-term yields is not working. So much for the influencer. Now they're going to become the bully in the market. Because if they do not, look out below. Now, this is pretty interesting. This is the high yield spread. The symbol is double hashtags. I got to put my glasses on. Double hashtags IOAS. And basically this is the spread on high yield debt in red. And here's the S&P 500. We look a lot similar now, but far more overbought than we did back in 2020. And for reference, for a frame of reference, we had one of the greatest corrections in history during the financial crisis, and we're nowhere near as overbought as we were back then. So this wedge formation, this ascending wedge formation on the S&P 500, which has been broken a couple of times now, only to bounce back like the Michael Myers of the stock market. Michael Myers being a reference to the bad guy in the movie Halloween, for those not familiar. But he kept coming back from the dead. So this is where we're at, folks. High yield debt hooking back up. You're seeing, where is it? High yield debt on a weekly time frame. That's coming under a little bit of pressure. We're up on the week, but again, very, very thin volume. We broke support last week. You don't want to see high yield debt going in the wrong direction. So we have some issues out there. Other issues that are haunting the market, and this also goes back to 2007, 2008, really. U.S. existing home sales are set to close at 4 million in 2024, marking the worst year since 1995. So worse than 2008. Sales are set to be even lower during the 2008 financial crisis. The lack of demand for existing homes comes as home prices have jumped over 50% since 2020. Over the same period, mortgage rates have nearly tripled, making affordability even worse. The average rate on a 30-year mortgage is up 100 basis points since September. That's when the Fed began to cut rates to 7.1%, despite the Fed cutting rates by 100 basis points. So it's clear that what the Federal Reserve is doing is not working. And the reason why it's not working is because inflation is still high. We'll go to a chart of that in a moment. So what the bond market is saying to the Federal Reserve, you got to pay up. And they're saying it to the Treasury as well. You want to borrow money out on the 30-year curve or the 20-year curve, 10-year curve, you got to pay up more money, or you got to become the buyers of last resort, Federal Reserve. So the impact that this has on the overall economy is it's It's huge. You have real estate agents that are out there who buy cars to show people. Those cars aren't getting purchased as frequently. They're holding on to those cars longer now. Uh, Building permits, housing starts, construction workers. They're not working as much as if we had a vibrant economy. And who else suffers? Those who sell equipment, John Deere, uh, etc. The local deli who provides the lunches for these guys, they're suffering. So it's a ripple effect throughout the economy. Once you get home sales begin to weaken, what do? The first thing you buy a home, you buy paint, you buy a new washing machine, new dryer, bedding, whatever. There's a huge ripple effect. There's it's very, very bad. And the problem is this, is that when the Federal Reserve goes back and starts buying debt and reduces the long-term yield, that's not going to make home prices go down. It's going to make them go up, because you're going to have people that are entering the affordability realm of being able to buy a house because yields have come down. Well, guess what happens? Prices go up because now they're chasing the availability of what's on the market. So as much as I want to be optimistic, I can't, because as it stands right now, it appears as though the markets are dependent and reliant upon a Federal Reserve. We need the Federal Reserve to take a step back and allow GDP to grow, allow this economy to take the hit of layoffs in the government sector, reduce the size of government, take all the bad medicine that they need, and then let all that capital that was flowing into the government, wasted, let that become financing through the Small Business Administration. Let that flow out to the private sector. Let the average guy or gal keep their money and invest it as they see fit. That will drive yields down organically without the chicanery of the Federal Reserve. I just don't think that they've gotten the message yet, because they want to be important. They need to be the center of the universe, or else they become obsolete. And it's the last thing that they want. Now, I'm looking for reasons to get bullish on the utility space, to see a sign of the fact that the utilities may be making a bounce back, and maybe saying, why is he looking at utilities? The reason is that if I were to see the utility sector firm up relative to the S&P 500, that would give me an indication that the traders out there will be expecting that the Federal Reserve will have yields on the longer end of the curve lower. But when you take a look at this is a ratio chart, utilities versus S&P 500, monthly view, only a couple of trading days left to go in the month. You can see it's clear, it's defined. We're probably going to take out the prior lows. We remain in a bear market on a relative basis. And even if we take out the S&P 500, I mean, brutal month. The trend here is up, but if you're looking to put a dollar to work, that dollar is best spent at current anyway on buying S&P stocks rather than the utilities. So we have a lot of challenges here in the market, and it's highlighted in particular with the yield curve. The yield curve this is not updated for today. This is as of the 23rd. I'm surprised I didn't update this by now. But I can tell you right now, I was looking at the yield curve earlier today, and it pulled back a little bit. So yield curve still breaking out, and when you take a look at it on a monthly time frame, I hate to keep hammering home at this, but history has shown us, you get up into this range, things get real fast. Did this update? No, it didn't. We're right at the highs of the month. Factoring in today and the fact that this is not updated yet, we're slightly off the highs of the month, but we're well within this red zone, and it's red for a reason. Bob, what are your thoughts on oil and gas given the recent correction over the past few weeks? Do you see opportunity? Does it have more room to go further down? All right, so we've been talking a lot about this lately, and we could skip right to the charts of energy and have a conversation about it. We've been doing some buying in the energy space, not a ton of it, because what I've been waiting for is a big move breakout on oil. Is this updated yet? Yes, it's updated. We're trying to break out. This is a weekly chart of oil. And you may be saying, why am I looking at oil, not looking at the energy stocks? Because as goes oil, so goes energy stocks as measured by the correlation. Let's see what that looks like. We always want to know our correlations. What is the historical performance of both asset classes? And you could see that at current, there isn't a lot of correlation. Energy has continued to decline, whereas oil has gone into a consolidation. Now, that all changes. If you go back further in time and you take a look at a monthly chart of oil and energy, they're very, very highly correlated. It's just since September of 2022, we lost that correlation. We have a lower high here, but there's no reason not to believe it's not going to resume. Right now, they're both in consolidations. They're doing a lot of nothing. Oil and energy in particular has really just started to really break support levels in earnest. So we did a little bit of nibbling last week on Gush, which is a leverage product. That's a Direxion product. We also bought a little bit of, what the hell we buy? EOG Resources. And only a nibble. So we have our foot in the door, but given the fact that you still have momentum as measured by stochastics on a monthly basis, trading down below 50, we know that rallies tend to fade. And last week, we broke weekly support. This week, we're doing a check back. We could easily see a reversal and a move lower. And what we also want to do is take a look at seasonality and say, okay, in terms of seasonality, are we entering a seasonally favorable period of time? Or is it not even worth having the conversation? And you could see that we're entering a seasonally favorable period of time. January is still a wonky month, right? It's not a good month, but the weakness in January should be viewed as a buying opportunity for energy stocks, because then you have a 3-month sequential rise, February through April, where they generally trade up. And if you want to take a look at this on a weekly time frame, the first week out of the new year is generally a pretty good one. Second one, that's probably going to be the area at which you want to pounce. And then enjoy the ride up through. Let me set this back to monthly. Through March and April. So I think we have a trade that's setting up. I just don't want to get overweight at current. I think that you can still get better prices on these names. Oh, I didn't share my. Oh, God. Oh, God. Was I not sharing my screen the entire time? Oh, my God. There we go. Thank you for that, V. V Peoples. Thank you. So let's go back to the energy chart. So here's the correlation I was talking about. Weekly time frame. At current, we're not highly correlated, energy and oil, right? But historically, when you go back on a monthly time frame, you could see that when these are rallying, oil and energy stocks, their correlation is lockstep. So we're not seeing that yet. And frankly, energy on the month is not looking great. Doesn't mean it can't gap up in the beginning of next year, but I worry. And in particular, I worry about the breakdown from last week below support. So, and the fact that you have momentum is measured by Stokes trading down below 50. That's a big problem. That's a major problem. So we need to get that in the rearview mirror. Longer term, once we start seeing GDP growth organically, then I'll become a lot more constructive on energy stocks. Thank you, George. Thank you. I'm still a little bit groggy from Christmas. Too much sugar. Okay. Let's talk about the weekly charts and the bullish percent index. Now, this is what leads me to believe that we could still get a healthy rally in the markets. And some people may look at this chart and say, wow, there's no bullishness out there. And that's a good thing. You're climbing a wall of worry. So we could still get a rally. We were up today. We're pretty oversold. So don't rule it out. Now, this is what concerns me about, we have a market that is seeking out lower yields, right? That's what's holding the market back from going to even more frothy levels, are more cheaper yields. So what if unemployment rises and the Federal Reserve begins to go back and buy back our debt, thus igniting inflation because the government can't stop spending? What you're looking at here is the CRB commodity index, and it is getting ready for a major, major breakout. So, when you see baskets of commodities moving up higher, and the Federal Reserve now going to begin to inflate their balance sheet, which is what I'm predicting in 2025, it's not going to bode well for Main Street. Those without assets are going to do very, very poorly in this economy, unless, of course, they cut the spending. That's what's necessary. If they cut the spending in Washington and that money, again, goes out to the private sector, we'll be good. But then the deep state's not going to go down without a fight. Now, looking at the TLT, 20-year bond ETF, forget about the weekly chart. And I rarely say that. Let's take a look at the daily chart, because an interesting event took place today. And while it did not close up on the session, I think we're going to rally on the TLT. So this is what I call a cluster of candlesticks. We were in a downtrend channel. We have, what did we close at? 37.82. We broke out of this downtrend channel today. So if we continue to consolidate along this level, we should get a rally, at least in the short term. That'll bring yields down a bit, and that could allow the equity markets to rally a bit. Taking a look at we already went over yields, tips, Treasury inflation protected securities. There's no fear about inflation right now. That's what this chart is telling you. Zero. The reason why is that bond yields in the US dollar are very, very strong. If yields drop, dollar drops, inflation concerns remain. Gold, silver, tips, anything you could drop on your foot and it hurts, you want to buy. Till then, avoid. Speaking of the dollar weekly chart trading at the upper band of the rising uptrend channel. In fact, I would argue at the upper band of a trading range and entering the apex of an ascending wedge formation. Does that mean it can't break out higher? It certainly can. Can it continue on for a few more weeks, get into a tighter consolidation? Absolutely. Euro. No new weekly lower lows. Interesting. One trading day left to go. Yen, weekly view. Horrible. New weekly lower lows. We're probably probing back towards the lows of June. Bitcoin, completely risk off right now. It's still up on the week, but man, what a wallop we caught today. Down 3,725 the coin. This to me looks like a bull flag setup, and we could break south. We closed down below 32.4. We're heading down to 87.5 on Bitcoin. Volatility. There is none. Daily view. The volatility index actually closed up today. The front month contract did not. Actually, no, it did close up. My apology. It closed off the highs of the session. Reversal bar at the 200-day moving average. Dow Transports. They recovered some real estate last week to close back above support, and we're holding it this week. But the volume, folks, I can't treat this like a normal week. It's not a normal week. It's just computers trading back and forth, keeping everything in check. No drama. They don't want any drama. When I say they, I mean the whales. The Dow Jones Industrial Average. No new weekly lower low, but we are rolling over here on momentum. S&P 500 up 1.72% on the week. Were this a non-holiday week, I would say we're probably breaking out to new all-time highs. But I know this candlestick is sitting on a cloud of smoke, so it can evaporate very, very quickly because there is no volume. Let's take a look at the daily chart. Typical holiday week. Nothing unusual here. Let's skip the equal weighted. Let's go to the Qs. Weekly chart, inside bar on the week. Again, were this a normal trading week with decent volume, I would say, wow, this looks great. We're going up higher. We don't want to play that game. We know that there is no volume here. There's no conviction on the part of anybody other than a 1 and a 0 inside of an algorithm. That's all it is. Look at the volume. Can't get excited about that. Let's go back to the equal weighted. That's looking good too. Small caps. This is a leveraged product. Let's bring up IWM. Up over 1.5% on the week. But note, momentum rolling over here. Doesn't mean it can't do a V-shaped recovery. It can. But yields need to drop for the small caps and mid caps for them to break out to new higher highs. The banks, they broke out this week. To be fair, they broke out last week. Let's update the chart. And we got a continuation move this week. So the banks are looking good. I just wouldn't chase them. There's no volume. Technology, weekly view. This looks good. I mean, it looks like it wants to go higher. We broke out, God, how many weeks ago now? About 4 weeks ago now, and it looks as though we're getting to make another running charge higher. My guess is that the semis are gonna join suit, and they're trying to break out this week. No breakout yet. If you're buying them now, you gotta stay real small because you're buying into weekly resistance. We get a close on a weekly basis above 250 this week or next, then I become more bullish on the semi stocks. I like the way RSI is holding 50. That's the neutral level. We have a probable higher low on stochastics. But again, you ever watch the movies when you're a kid and a guy lost in the desert and he has no water, he's out of water, and he sees this oasis that isn't there. Uh, it's a mirage. So that's what light volume brings you. It creates mirages. So this looks great. It looks like an oasis in the desert to a man who hasn't had water in 3 days. But the problem is that it's fleeting. So we don't want to be left next week, the week thereafter, drinking sand. What we want to do is make sure we close above a resistance level. And then the following week, we get a retest of this breakout point, and then we get follow through to the upside. Then I'm a buyer. Then I turn both. But we want regular volume back. Let's go to a daily view, see how we're setting up here. Looking good. Down day, but all down days not made equal. We broke out of this bull flag setup. We have a nice W formation that's highlighted in this beautiful, beautiful lime green. And I like the setup. I think we're going higher. If we fail, look out below. Software correcting, not much to do here. Biotechs, I know they were up today, up on the week as well, but still not closing above resistance. Staples, bad breakdown last week. This week, a bullish reversal bar off of support. Stokes trading down below 50. Rallies tend to fade. We're not bottom dipping here. Emerging markets, weak and getting weaker due to the stronger US dollar. Avoid. But the one thing to remember about emerging markets right now, US stocks are trading at historical premiums relative to the rest of the global stock market. So we may not be the most expensive in NASDAQ terms or in S&P terms, as we saw back in 2000. In terms of the United States stock market valuation versus the rest of the globe, we're at all-time highs. So these stocks are cheap on a relative basis. The problem is that it's twofold. One, the dollar is strong. When you want to buy emerging markets is when the dollar is weak. Why? Because these emerging markets are very much in debt, and that debt is denominated in US dollars. So if the dollar is going down, that probably means that yields are going down. And that means that the GDP is growing because the Federal Reserve is out there doing their monetary shenanigans. So what happens? GDP starts up. Then since the economy starts growing again, you need commodities. What do emerging markets generally produce? Manufacturing and commodities. So now their economies begin to grow and they're paying back their debt with cheaper US dollars. It's like a tax cut. So when we do get our correction here, that big shakeout in the market and return to normal valuations, one of the first places I'm looking is emerging markets. I want to buy emerging market stocks because they're cheap and they'll do very, very well. So this is one area where I could see in 2025 bottoming out. They will fall. They're correlated with U.S. stocks. So when our stocks fall, they'll fall as well. But they'll probably be one of the first to recover along with gold stocks and commodities. Speaking of gold, Gold is up on the week. This is firming up nicely. No doubt we're up on thin volume. Yep, very, very thin volume. So we need to get our crayon out here and say, okay, we use a rules-based approach for approaching anything. If this, then that. If we break out above this upper band of resistance, we buy. If not, we sit, because it could easily just break down as well. I doubt it. The one thing I don't like here is that momentum is going in the wrong direction. No bueno. We want to see momentum break out to the upside. Gold stocks. Now, I did my first buying of gold stocks, GDXJ, last week, since we sold half of our position right here, October the 21st, 2024. So I bought back, we sold 700 shares. I bought back only 100 shares, 1/7 of our existing position. And I'm going to look to add more to this position in the coming weeks and months. The reason is that when you take a look at seasonality, on a monthly time frame does not look great here, and it's not great. But when you drill down, you take a look at you look at this: November horrific, December horrific, going back 15 years. But if you take a look at it, the first couple of weeks of the new year are a couple of the strongest back-to-back weeks out of the year. And the last week, this week here, is about 50-50. So I think that we could even get better seasonality if we drilled down and only went back 10 years, because we had a bear market in there, and a very long-term one at that. So let's go back to the monthly chart, and you can see that January, which was a red month, is still a laggard in terms of being up more than down, but it gets a lot better. So I'm actually thinking that we're going to get a rally here in the gold stocks in the next couple of weeks. Here's a weekly view of seasonality. We're up 55% of the time the final week, only going back 11 years, and then 80% of the time the first week out of the year, and 64% of the time the second week. So I think I like it for a swing trade, in, out, and then we pull back, wait for a good re-entry point. Let's do some chart requests. All right. Folks, if you're watching this, you're not part of our forum, please head on over, sign up, enter your symbols. No credit card required. It's free. Use that link. All right. Let's begin with Sean, Mr. Sean with Rumble. Marvel for gay. BIDU for Tim. Hey, Tom, please. Thank you, Bob. I think my first alert here was around $4 or $5, $13 and after. Wow. Okay. Okay. All right, let's do it again, folks. We're using TrendSpider, automated technical analysis. If you want that seasonality I just went over, You get it with your subscription to TrendSpider. Get a bare minimum of 35% discount code. Link below on YouTube, linked above on Twitter. It'll take you on over there. Take advantage of it. I give it away free to our silver and gold level members. It's included with your membership to the Contrarian Trader. And the version I use is the version you get. And I have all the functionality. Let's begin. Rumble. Monster. Oh. All right. There's not a lot of data here to use the algorithm to help us out, but we don't need it. I think if you get a pullback to $10 per share, and it's entirely conceivable that you can open up a position or add to your position. That's the monthly view, weekly view. The auto fibs are telling us that we have those weren't auto fibs. Sorry, guys. Oh, it was here. Support down at around 1447. I don't know. It's a little bit too tight for me. I would need more of a shakeout here on Rumble to open up a position. But, it's not really the question you're asking. If the question you're asking is it going up? Probably. The path of least resistance is clearly to the upside. Here's another support. Well, yeah, it's funny. That coincides with the Fibonacci retracement right here. So maybe that is a good point at which to nibble. Or if you're looking to use a stop loss and it breaks down below that mark, you lighten up a little bit. But it looks pretty good here. Now, Sean, you know me long enough. You know what I'm about to say. We have the Bollinger Bands that are really stretched here. So, were I long, I would stay long. Maybe I would put in a trailing stop loss order, say 5% trailing stop loss order, take me out of half of my position, carry the rest, use it as a trailer. If I'm looking to reestablish a position, wait for either 1454 or $12 a share. And for a real pullback, a 10 handle. And these are very, very volatile stocks, so it could definitely happen. Especially with the equity market so overvalued right now. So me personally, I would be using a trailing stop loss order, at least a portion of my position, because there are a lot of profits that have been made here. MRU. Good looking chart. Could be setting up for a bull flag setup on a monthly chart. On a weekly view, we're right off of that support level. We have a Bollinger Band squeeze that's setting up here. The problem is we don't know if it's going to fire off south or north. I don't know what the fundamentals are, nor does that matter. In recent, we've seen a lot of breakouts fail on really top quality stocks lately. So I don't know if that matters too much. It's just the time of the market where you see breakouts fail. That's never a good thing. But you had a nice Bollinger Band squeeze. It fired off south. Are they liquidity hunting? Are the institutions liquidity hunting? It's possible. I would not be a buyer of the shares until we close back above the 20-period moving average, which is currently around $50 a share. That tells me that in all probability, they're going to take it up higher. Right now, the pressure's to the downside. Momentum on a daily time frame is hooking up. And we're breaking out. I think this could rally, but we need to start taking out. That's not what I wanted to do. We need to start taking out prior highs. Right now, we're continuing to put in lower highs and trying to put in a higher low here. Let's see if that holds up. I don't know. The jury's out on this one. This is a show me stock. It's got to show us that it wants to come back. Right now, it's a question mark. Baidu. Nice. Wise. Okay, good. All right. Baidu, weekly chart. It's consolidating. Monthly chart. You would think with all of the liquidity that they're pumping into the economy there, that this would be doing something more, but it's not. I think this is one that you can open up a position of the common stock. I would sell covered calls against it. You don't have a breakout. But if we begin to break out and above 88.50 per share, I would stop selling the covered calls, and I would stay long of the stock. And I would also be okay with selling puts here as well. You could even do an iron condor. You could sell strangles here. You want to be really neutral on the stock. You could use cash flow strategies to generate some cash flow. But if you're looking to buy the stock, me personally, I always love a bargain. So I would be selling a put on this and averaging down my basis cost. If the shares are assigned to me, I begin to sell covered calls until it begins to break out above resistance. And then once you start putting in higher lows and higher highs, then you want to hold off on the call selling until the stock gets extended, and then start selling some calls because you don't want to miss on your upside appreciation. So, like in the case of Sean, that stock Rumble got ahead of itself. He sold covered calls. He did the right thing, and that's fine. TGTX. This is looking interesting. TG Therapeutics. It hit resistance, backed off, consolidated. Bullish key reversal bar on the week so far. Remember, light volume week. Daily view. This is looking really good. I think that they're going to move this up higher. Stokes moving up. You have a Bollinger Band squeeze that's forming, not quite there yet, but forming. I like the setup. I'm bullish. I think it's going up. ATOM. Okay, let's try that again. Whatever that was. Okay, ATOM. Do I have the after hours on here? I do not. There we go. There's the after hours. It's going up. Wow. So what you're looking at here, folks, is the firing off of a Bollinger Band squeeze. In red, you have the Bollinger Bands. In green, you have the Keltner channels. And now you're beginning to see that setup, that energy that we've seen for months build up, years now, actually. Uh, that energy's been pent up, and now it's being released and is being released up. It's a very bullish setup. I think that this is going a lot higher. Today, we blew through a resistance level like a hot knife through butter. If you're looking to add more to this, I would look for a retest of 1137 per share. It looks good. I think it's going up. That monthly Bollinger Band squeeze is no joke. This is no joke. There's a lot of energy built up in here. Going back to God. Yeah, it fired off. See, yeah, the same thing it fired off back here. Look at how tight that was. That went from what? Around $6 a share up to 46. Holy cow. 47. It's going up. TQQQ. This is the Ultra Pro Triple Qs. It's a bull ETF. The path of least resistance at current remains up. You know, if I had to flip a nickel, I'd have to say it's going up. But in the back of my mind, I know that this ETF and the S&P 500 is being led by only a few stocks. And when they pull the legs out from underneath it, it's going to fall really, really hard. So if you're going to buy it, I would use a trailing stop and let the market take you out. Because when this goes, it's going to happen fast, really, really fast. Nugget, we kind of already went over this with GDXJ. We're becoming oversold on stochastics. I would like to see another washout here down to the low 30s. If by chance it flashes a 20 handle of any type, I'd be a buyer, hand over fist. Because at some point in time, the Federal Reserve is going to have to step back in and they're going to have to buy this debt. TNA. This is the small caps. We kind of already went over this already. They need lower yields. They're holding a support level. They're going to have a lot of problem pressing up higher. If yields move up higher, I would be very wary. This bullish reversal bar looks really, really good. Really, really good is up on volume that is virtually non-existent. Here, one trading day left to go. So I want to be bullish on them, but the reality is if yields press up higher, it's going to be very difficult for the small caps to move up higher. So I would be very careful here with the small caps. RSLV, I'm going to leave it off here because my voice is going. RSLV. Is that not right? RZLV. Resolve AI. Looks good. It's broken out on a monthly chart. Assuming that we close there, what do we have? 3 trading days left to go. So in a situation like this, we take our crayon out. Show me a close above 510 per share. I'm a buyer of the stock. Stokes beginning to hook up. Sorry, guys, my voice is shot. Now, we do have a lot of overhead supply up here. You're going to need volume, and you have volume. This is a weekly chart. Look at the volume. It's a holiday week. So the shares are under institutional accumulation. Looks good. I like it. RZLV. Guys, that's it. Thank you for being here. Don't forget, TrendSpider, 35% discount code below, bare minimum. And sign up for our 14-day free trial offer. Get it for free. And I will talk to everybody on Sunday night. Yeah, we have one live stream to go before the new year. So I'll see you there. Members, I'll talk to you tomorrow. Till then,